Howdy out there, folks. We appreciate you guys for joining us today. I am Darius Dale, founder and CEO of 42 Macro. I'm joined by a good friend of mine, good friend of the firm, Larry Baxter, global macro investor extraordinaire. How you doing today, Larry?
I'm doing great, Darius. Thank you.
Yeah, I appreciate you for joining us. So, folks, we put together this presentation for you. We know a lot of you guys are in the community and the ecosystem, kicking the tires on the process and saying, "Hey, what's going on over there? Why are so many people high fiving Darius on Twitter on a consistent basis?" And so, I guess we appreciate the interest. And what we're doing today, is really putting together a sequence of slides that'll help you understand the 42 macro risk management signals, the grid regime process, how it's different, how it's unique, and more importantly, how it can help you make and save money. So just hopping right into the deck here. Again, learning the process. Welcome to the grids. So starting with slide 3 here, introducing our 42 macro grid framework, which we use to measure bottom-up macro regime cycles. You're going to hear me say that a decent amount. Bottom-up macro regime cycles versus top-down market regime cycles are two separate processes, and our investment allocations, our actionable ETF trade and ideas stem from the intersection of those two processes, those independent processes. And so what we're looking at here on the x-axis, we're showing the 3-month delta, or the impulse, the trending impulse of headline CPI on a year-over-year basis. Then on the y-axis, we're showing the 3-month impulse of the OECD Composite Leading Index time series. Why do we use the OECD Composite Leading Index time series? Well, number one, it's standardized across economies, so we're looking at the same type of data sets. If you look at something like GDP or employment statistics, the further you get away from those types of things, the more likely it is the calculations are disparate. Obviously, the most disparate example being the U.S. versus China in terms of how it calculates and maybe lies or does not lie about its GDP statistics. So this is what we're trying to do, is standardize the process. But more importantly, I think the biggest evolution and the biggest benefit for looking at this particular time series is it actually gives you a monthly read on the data sets, both in terms of the modal outcome, which is represented in the first row here, but also with respect to the conditional probabilities, because those are extremely important as well, as we'll highlight later in the deck. And so what we're ultimately trying to do is help the end investor understand, hey, where should we start to anticipate an inflection in the economy? And then as a function of that anticipation of inflection in the economy in either growth or inflation terms, or both, when should we start to begin to anticipate inflections in the market leadership, sector and styles factor dispersion, across asset class volatilities, things like that. So this is process, in our opinion, gives us a lot more color and a lot more clarity, and more importantly, a lot more nuance in order to help you make and save money and actively use the growth and inflation data to manage your market risk. So as you can kind of see here, we're heading into a sea of Ds. D stands for deflation. That's where both growth and inflation are decelerating simultaneously. Let me take a step back and just introduce those regimes. So Goldilocks, that's where growth and inflation are, growth accelerating, inflation decelerating. Reflation, that's where both growth and inflation are accelerating simultaneously. Inflation, as many of you will call stagflation, that's where growth's decelerating and inflation's accelerating on a trending basis. And then lastly, again, got deflation. That's where both growth and inflation are down on a trending basis. And so, as you can see, we basically we're in reflation for over a year. Transition to 1 month of D in September, we saw a market correction associated with that. We did see a recovery, as I do believe you could see some art now casted R here in November. But the reality is that R is likely to be proved to be very fleeting, heading again into the sea of Ds into next year. So that's our process. This is our process. This is our forecast. So as always, we're measuring and mapping the data daily, updating the nowcast to get you to the appropriate to update those probabilities accordingly. On the growth side, again, one of the reasons we use the composite leading index time series data, I get a decent amount of questions on this, is one, it correlates to the year-over-year real GDP statistic. It actually tends to front run the year-over-year real GDP statistic. If you look at when the composite leading index data tends to peak and tends to trough, you typically get that peak and trough 2 to 3 months ahead of the actual GDP data, one being realized, but also 3 to 4 months of it actually being reported in most countries, given the lag with which national account statistics tend to be reported. So what this process does, what this data set gives us, is an opportunity to be bigger, better, faster, stronger than traditional regime segmentation processes that again anchor on slower moving data points. And so what we're seeing here, looking at it, zooming in, we're kind of cresting at the peak of this sine curve, and we're likely to head lower on a trending basis over the next 12 months, with a lot of the slowdown risk really starting to materialize in the late Q1, early Q2 event. Notice I said late Q1, early Q2. I'm not saying Q1 or Q2 because, again, we have the ability, going back to the previous slide, to actually see when the speed will start to really change in what particular months. And that gives us a little bit of granularity and a little bit more color on when to start to actually make those investable pivots. Just hopping into our nowcast model here. So we're doing the same process for every country. It's the same process, same data, or same processes, different data sets, obviously feeding into the nowcast models in every country. And then we're doing the same process with inflation as well. So again, using headline CPI on a year-over-year basis. And what we're trying to do is, again, effectively forecast the change in the CPI. It's not the level of the CPI, because obviously we're talking about a really big level here, but every time you're at the highs of the CPI print, going back, every single time in everybody's career that I'm talking to today, there's some clear asset allocation pivots you should be making. Nobody wants to buy bonds here, but again, this is when you start to buy bonds as an investor, when you're at the peak of the inflation sine curve. This is when you start to high grade your portfolio as it relates to anything that's inversely correlated to interest rates. So I've seen a lot of questions on that just in the community on, okay, hey, yeah, inflation's really high, but you're starting to buy bonds. And again, just like inflation was at the cycle peak back here, inflation was at a cycle peak back here, inflation was at a cycle peak back there. And each one of those times you had an opportunity to take advantage of that in the fixed income markets. Same process. Good.
Love how the information there is monthly. That's a lot more accurate than taking things at a quarterly box. And also you can see from month to month how those boxes shift.
Yeah.
It also shows that because it's the rate of change that matters, whether something is the top of the sine curve or whether it's exponential, it's very very challenging, very hard to determine. And so knowing whether that slope is about to roll over or not is why things are so difficult to forecast when we're right at that edge of a transition.
You hit the nail on the head. And again, every forecasting process has forecast error. What we're trying to do is help investors narrow that forecast error into an investable sort of framework that allows you to sort of make bets with confidence, as opposed to sort of saying, well, inflation's really high, so I'm concerned about it jumping off the top right of the page, or inflation's really low going back to April of last year, and I'm concerned about it falling off the bottom right of the page. What you're trying to do is help investors, shrink the tails, and so that we can invest with confidence within the median of the probability distributions. And so skipping ahead here, we don't look at valuation a ton. We do have a valuation overlay in the process, but what typically happens is valuation, in our opinion, tends to be a lagging indicator with respect to influencing asset markets relative to the impulses in growth, relative to the impulses in inflation. So you can check that out if you want to check it out. But again, we certainly think the core features of the process to do a much better job of forecasting trending asset market performance on a trending basis. Moving on to slide 9 here. So that process I just highlighted with the U.S. economy, again, doing that exact same process every single day with all 35 of the world's largest economies. So these are the countries that the OECD publishes the Composite Leading Index time series for. And so what we're allowed to do is, what this helps us do, is just visualize very quickly with colors, what's happening in the global economy, the U.S. being the top row, the most dominant model, the most dominant feature in the model. But the reality is, all these countries do contribute, and they do add up down here in terms of the median conditional probability. So it's super, super important to understand the probability statistics. And what the probability statistics effectively show you is how far, or how close or how far you are away from the origin. And so if you're in, you had a 100% chance of being in inflation, that means your one of these dots is down here at the bottom right, or about, if you're 100% chance of being in inflation, that dot's down at the bottom left. If you have a 5% chance, it means your dot is very narrowly, very close to this. And so, or it could be in a different regime. And so what we're trying to do is help investors not only understand the changing in the color scheme, as you can see, the colors really start to change, once you get into the latter part of the fall and into the early part of the winter here for most of the economies, but you can understand how they're changing. Is this a very dominant inflation or stagflation regime? I would argue it's not. Quite frankly, it's, there's still a decent probability, as you look here, of realizing reflation in the, in Q4 specifically. But the further you go out in time, the likelihood that you start to realize anything positive economically, obviously, basically drops to nil. And the probability that you realize deflation really starts to increase, and it gets, really, really high, starting around the middle of Q1 all the way through kind of the into the early fall of next year. So those probabilities really matter. And as we'll talk about in a few slides, they certainly have a tremendous amount of market impact. Going from a 91% conditional probability of pricing in reflation, both for the US economy and also for the global economy, this is the median for the globe. That is a very different market response than a 39% probability or 31% probability as we're currently seeing here. And so you need to understand that, in our opinion, in order to get asset markets right, which is obviously the entire point of the process.
I love the combination of the color coded chart, which makes it very easy to see at a glance globally what
Hmm.
has been going on and what's likely to going on. But also, you have those specific probabilities there. It's not just Darius kind of weeding out what do I think's going to happen. Is it going to be reflation now, and just yes, that's what it is, and we just go forward in that. Rather, you see the conditional probabilities and what is most likely to happen there, and as the data changes, that changes, and the data behind it is very quantitative, very systematic. It's not an arbitrary prognostication of what's going to happen in the future.
Totally. I appreciate you calling that out. Thank you, Larry. All right, so keeping it moving here. So, it's not just enough to understand what the economies and asset markets are doing. We need to understand it in the context of what asset markets are likely to do, again, as a function of the change in the colors, and more importantly, sometimes the change in the conditional probability. So, one thing we've done, we've back tested everything that ticks through the lens of that regime segmentation process, that grid process, Goldilocks, reflation, inflation, deflation. That's the first row in this column. Again, across annualized expected returns, percent positive ratio, volatility, covariance with US equity beta, number of observations in the trailing 25-year sample. And so that's the first row here. You're obviously understanding, okay, in Goldilocks and reflation, you have a really good shot probability of making lots of money in the stock market. But obviously, once you transition to inflation and deflation, not only is the likelihood that you make money goes down, but the volatility tends to increase as well. And so that's something you can understand that, but it's not just enough to know, whether you're in that regime, just from a broader regime perspective. We've actually sliced and diced these back tests, as probably as well as anyone in the world, quite frankly, in terms of understanding different impulses alongside those regimes. And so what you're looking at, -2 sigma delta on growth, that means growth is slowing at a 2 sigma pace. The delta on growth is a -2 sigma pace relative to the trailing 3-year sample. And so, as you obviously can see, that has a much worse, much more draconian impact with respect to stock market performance when growth is accelerating to the downside very, very quickly. If you look at something like a 0 sigma delta on growth, so that means relative to the trailing 3-year sample of 3-month impulses, growth's only slowing very modestly. It's right in the middle of the kind of distribution there. And so you can see something like deflation, when growth is slowing very modestly in deflation, you actually have a positive expected value. So that's something to be aware of and keep in mind. And it's something that's obviously helped us remain invested throughout the summer months in the context of understanding that the economy was transitioning. Our models were not calling for a meaningful deceleration in growth like this one would imply. This circle here would imply. It was actually calling for something that was a little bit more modest, which allows you to, again, to remain invested in equities and certain types of risk assets. So again, that's how those processes work. Same deal with inflation. -2 sigma all the way to +2 sigma. +2 sigma means inflation, the size of that 3-month inflation delta that's contributing to that grid regime spider chart, that plot. That size of that delta is a 2 sigma relative to the trailing 3-year sample. And so, as you can see, when you go into stagflation, or inflation as we call it, and inflation is moving really high, really fast to the upside, that's a really negative scenario for the market. In so much that when you're going into deflation, but you're only slowing modestly with respect to inflation, the market is either flat to up a little bit. So you have to understand all these different dynamics, and more importantly, increasingly as we go forward in time, the policy dynamics are very important as well. What's the Fed doing with the policy rate? Obviously, nothing now, but we're going to be transitioning into a year where there's going to be a lot of action, could potentially be a lot of action on the policy rate front. We'll see. Quantitative easing, quantitative tightening. What's it doing with this? Fed's doing with this balance sheet, and then fiscal easing and fiscal tightening. So what we're trying to do is, again, use these back tests to inform us based on our views on how the Fed is going to respond to our forecast, how fiscal policymakers are going to respond to our forecast, to help us get into the right asset allocations and make those decisions and pivots appropriately. So again,
Bayesian factors. So
yeah,
you're looking at conditional probabilities. In other words, how does a stock respond in reflation? Well, that
Hmm.
depends a lot on whether it's very strongly negative in inflation or positive.
Hmm.
Same thing for growth. And so it's not enough to say something is in reflation to know how a ticker is going to perform. And it's actually not even enough to call it shallow or deep. It really depends on the different impacts of growth, inflation, and policy distinctly, and you blend those all together to get an outcome. Is that, am I understanding that correctly?
You're absolutely, you're so good at the process, my friend. You're front running. I love it. So I'll skip ahead a few. So here on slide 11 through 14, we're just showing the back tests on global equities, commodities, fixed income, foreign exchange. And again, slide 15 here, we've back tested everything that ticks so we can understand what tends to outperform and underperform in each grid regime. And again, these are the summaries of the overall back tests, not the Bayesian back test that Larry alluded to that we just talked about and we'll talk about in a second. These are the sort of, okay, if I know I'm in, deflation, these are the types of style factors I want to be long. Or if I'm in reflation, these are the types of style factors I want to be short, or the types of fixed income exposures I want to be short. So this is the generalized playbook, for those of you, sort of, who may have different views on how policy is likely to respond to growth and inflation dynamics, or who may have different views on the speed of the deltas in growth and inflation, or more importantly, potentially the actual direction of growth and inflation. I have debates with our institutional clients all the time on whether or not it's going to be a regime, this regime or that regime, because they have different data sets and frameworks that they're looking at as well. But going back to I'll skip ahead a little bit and we can go back to where we are, since we're on this topic. Larry, you mentioned that, one thing we do is we actually blend it all together, with respect to our forecasts and our back tests. So what we're showing here in these tables, this is the overall back test. So each of these columns represents an independent back test, going back to that S&P chart we just explained. What I'm showing here is that, the model allows us to select what regime, allows us to select how fast we think growth is accelerating or decelerating as a function of the regime, how fast growth is accelerating or decelerating as a function of the regime, what our expectations are on the policy rate on a go forward basis, what our expectations on the balance sheet, on a 3 to 6 month forward basis, what our expectations on fiscal policy on a 3 to 6 month forward basis, and what the rest of the world in. And so we blend it all together in this right column here, and then we rank them. You'll see why we rank them in a couple of slides. And so we do this process every week, every month in our Round the Horn and our macro scouting report. What we're trying to do is help investors understand what our process is suggesting to actually plug into the back test to get us into, these blended annualized expected return, percent positive ratio, volatility, covariance. And the reason we rank them is, again, because we want to help you visualize and appropriately respond to the risk reward setups for different exposures within the market. And so we've gotten a lot of outstanding feedback on these charts, both from retail investors, but also from institutional investors, because it really makes it easy in terms of summarizing everything. Like, clearly this table's busy. I understand that if you go back to these tables, but you take all the information from those tables, again, with respect to the expected returns, percent positive ratios, those blended rankings are on the y-axis. Then you have volatility and covariance. Those blended rankings are on the x-axis. And so the further you go out on the x-axis, the more risk you're taking with respect to those conditions, those economic conditions and those policy conditions as well. The higher up on the y-axis, the more reward you're receiving, in theory, from those economic conditions and policy conditions. And so obviously what you're trying to do as an investor is make sure that, you want to be along the efficient frontier. Your long exposures should be concentrated on this side of that line, and your short exposures or your underweights to the things that you're not invested in, because that's a risk management decision as well, are going to be on things that it's on, towards the bottom right. So, this is when you're talking about betting on inflation specifically. Obviously, things like the Qs, the Nasdaqs, the communication services, low beta healthcare, REITs, consumer staples, utilities. Those are the kind of exposures that tend to outperform, not only just in inflation, but also considering all these secondary considerations, because the secondary considerations, as Larry said, are extremely important as it relates to being Bayesian and ultimately help yourself position for the most appropriate market response to all these economic impulses.
Now, the charts here are actually some of my favorites to look at. That the scatter plot there for inflation and reflation, because there are a lot of investors who maybe have a little bit of a different opinion on where things are going,
Hmm.
or they want to ask, I really don't know if it's going to be inflation or reflation. So
Hmm.
you can look on those charts for things that are up in that upper left hand corner, that may be common between reflation and inflation, and
Hmm.
overweight your portfolio in those tickers. If you're particularly fearful of inflation compared to reflation, then you would, likewise underweight the ones that you would expect to underperform in that area. So
Hmm.
in the portfolio construction and the around the horn weekly, you're giving kind of your top choices already, given the forecast and your view on where things are going. But for the investor who, or the money manager who wants to dig in more, the data is all there, very nicely brought together for them to make some alternate choices.
Larry, you hit the nail on the head. Is what we're trying to do again by helping you vision. Because I don't want to come out and say, "Hey, well, I like this, so therefore you must follow me and do as I say." That's not the goal of the process. What we're trying to build here are systems and tools that help investors augment however it is they invest, or more importantly, whatever their investment objectives are. Because my investment objectives as a 35-year-old person is very different than someone else's investment objectives. And so the reality is, you can, understanding that, hey, heading into the month of November, there was a real healthy debate about whether or not reflation would transition to inflation from a market regime perspective. And, I won't provide any clues on that unless you're a paying subscriber. But the reality is, we were making the case that say, hey, if you're coming into the month of November, you want to make sure that the exposures you're long, are things that agree in both of these plots. For example, something like high beta, which is clearly a long exposure in reflation, drops all the way to the bottom right in inflation. So you don't want to be long high beta. That's not good for you. But something like the Q's mega cap growth, there's a very horizontal pivot there with respect to being long that kind of exposure. So that was those are our calls, and we made in recent weeks to say, hey, get rid of things that won't survive that transition. And more importantly, increasingly, we're of the view that this transition is heading into a D at some point in the early part of next year. And so, the next few, when I update these slides next time, inflation will be here and deflation will be here. And we'll start to have that discussion as well. So again, we don't want to get too far ahead of our skis in terms of giving the market time to one, move forward in time and price in the incremental economic data. But we also want to be cognizant of the fact that we see these dynamics changing on a go forward basis, because we have a lot of color and very accurate models that give us visibility into the future. And so we want to proactively prepare ourselves for those types of changes.
So subscribers with a different risk tolerance, or who
Hmm.
don't want to be in, uh, crypto so
Yep.
heavily, they
Yep.
would they would really key in on these charts, I think, to pick out alternatives for choices that are in the portfolio construction.
Totally. I mean, I've had this conversation a number of times with our RA type clients and Protopro subscribers. I have a few Protopro subscribers who are actually just retail investors, wealthy, high net worth individuals. And the reality is, these exposure, these charts help you, not only sort of identify, proactively prepare for, being long or long or short things, or overweight and in and out of things, but they also help you replace things. And so right now in the portfolio construction, we've had Bitcoin and Ethereum in there for quite a while now. The reality is, a lot of investors, particularly on the RA side, actually can invest in these things with their clients. In terms of how the regulations work, so you can't have these types of exposure. So when you sort of piece together, looking at the portfolio construction candidate slide here on slide 36, when you're blending all those scatter plots together across asset classes, because that's what the portfolio construction candidates will help you do, is kind of winterize it and say, hey, okay, if I can't be long these types of things, maybe I can go down the list and sort of replace it with something like this or that. So what we're trying to do is help investors. We're trying to empower investors to make these decisions for themselves. Obviously, we have a portfolio construction that investors can follow along with, to the extent that they don't want to make those decisions. But we realize, again, the what I think is the most appropriate set of market risks to be taking at any given interval may or may not agree with someone's longer term strategic investment objectives, and we're certainly well aware of that. And so again, we do this process against U.S. equities, global equities, commodities, fixed income, and foreign exchange. And so, again, these risk reward scatter plots really help investors visualize where they should be taking risk, and more importantly, as it relates to risk management, where they should be getting out of things. Transitioning back to the presentation. So definitely want to break that down. So going back to slide 16 here. Why does great work where we stand on the shoulders of giants? I'm pretty intelligent guy. I'm certainly not as smart as Larry, PhD math guy, but certainly I know my way around a few quantitative processes. And the reality is, regime segmentation has been around for a really long period of time. I'm sure most of you guys watching this understand who Ray Dalio is. I'm sure most of you watching probably don't know that his hedge fund has compounded 500 basis points over the S&P 500 over the last 30 years. I mean, this is how you build the biggest hedge fund in the world. That's, and again, compounded and average annual returns 500 basis points on average over than the S&P 500, which is, in my opinion, the most difficult market to beat in the world, the strongest investment in the world for most investors. And so again, this regime, the concept of regime segmentation has really been put to work, put to the test, and obviously it has delivered really good results for a lot of investors over a long period of time. Another thing, Danny Kahneman and Amos Tversky, the concept of not using confirmation bias, or more importantly, the confirmation bias is really the biggest risk we have to be aware of as investors. Is helping you creating a process that anchors on probability, and more importantly, analyzing and reacting to changing probabilities as opposed to confirmation bias, one that seeks out whatever the legacy positioning or legacy view is. That to me is really dangerous, particularly whenever you're around a pivot in the market regime cycle, which we'll talk about next. And then lastly, volatility being the leading indicator for price. This is something we learned from Dewan Manabrat, and volatility is a big feature in all of our models, particularly on the risk management side, as we'll touch on in a second. So skipping ahead, I mentioned earlier, we have two separate processes. One, our bottom-up macro regime process. That's what's the economy doing. How can we project the economy? What are policymakers likely to do in response to those changing dynamics in the economy? And then we have our top-down market regime cycle. So top-down market regime versus bottom-up macro regime. Two separate independent processes, and our risk management views live at the intersection of those separate independent processes. And so what this mobile macro risk matrix is doing is it's knocking on the door of the 42 most liquid, most widely followed market indicators in the world through the lens of what we call our volatility adjusted momentum signal process. Green is bullish, red is bearish, the exclamation points are neutral, and asking each of those markets, hey, do you think it's Goldilocks? Do you think it's reflation? Do you think it's inflation? Or do you think it's deflation as a function of its state? So for example, the Germany's DAX is bullish VAMS. Historically, according to the backtest, again, according to those grid asset market backtests from which we backtest everything that ticks in global macro, historically, the Germany's DAX index has been bullish whenever we've been in Goldilocks and reflation. That obviously makes a ton of sense. And so right now, both Goldilocks and reflation are getting a point from Germany's DAX. You can see that here on slide 23, our sum of confirming markets. And so we're doing that iterative process across every column and every row of the table, such that we allow ourselves at any point in time to understand which market is becoming the dominant regime, which market has the highest score of those markets, confirming it as a function, again, of those volatility adjusted momentum signals. And so right now, as you can see, we're recording this on Friday, November 26th. We put this presentation out, put this presentation together on Thursday, November 25th, and we deliberately did not update it. Obviously, there's a ton of volatility on Friday, November 26th. If you want the updates, there's some pretty critical updates as well this morning. So we invite you guys to subscribe and check that out. But the reality is this video is intended to be evergreen. So irrespective of what's happening in markets today, because obviously it's a pretty crazy day, the reality is what we're trying to do is help investors at every single interval understand which of those regimes is being priced in the most, which of those regimes is the dominant regime, and more importantly, understand just exactly how dominant is that regime. And one example of this is going back to early June. Sometimes the regimes, pricing in of the regimes, can actually get too dominant. Like this was early June here, where the reflation was the dominant market regime. It was just shy of its trailing 3-year peak of market. So at this particular time, I believe 35 or 36 of those 42 markets were saying reflation. And at the conviction score, this light blue line in here, it said, hey, that's a 99th percentile level of confirmation, which means, which we infer as investors, hey, investors are all on one side of the boat with respect to reflation. You got to start to book gains, which we actually did in this particular interval, saying, hey, look, a lot of reflation exposures are at risk here because everyone's already agreeing to agree that it's reflation. And so that's sort of one of the ways in which we use the process. Another way in which we use the process, we saw a similar thing in with respect to deflation going back to last April. You saw a similar thing with respect to Goldilocks going back to last August and September. And then eventually transition to reflation. So what we're trying to do is not only understand what the markets are pricing in on a trending basis, but understand whether or not they've priced it in too much or too little. Are we at the beginning of a transition that has legs and room to run? Are we at the middle or the later innings of a transition that might actually be reversing? And because again, a lot of times we talked about this, Larry, you and I in our macro bundle Q&A session. A lot of times it's not just the getting into the right exposures, it's the getting out that really makes your day or ruins your year, right?
Absolutely.
Yeah.
Yeah, no, for me especially, knowing when to get out is my biggest downfall, and the confirmational biases, the belief something is going to continue, definitely catch me a lot. Couple cases, I'll see on the weekly, it's time to get rid of something. I'm like, no, but I want to stay in there. And
Yeah.
like the uranium, the natural gas,
Yeah.
you got us out of that stuff just in time. And for once I listened to what I should be doing instead of what I think is going to happen, and that was good for the PA.
That out. And like I said, we're not here today to convince you that every trade we put on is going to be right. That's not the goal of this discussion. That'll never be the goal of any discussion we have. What we're trying to do is help shed some light on why we make the decisions we make, because they're all born out of a very systematic quantitative process that is proven to deliver results across time, both on an out of sample back test basis, but also on an in sample basis since we started the firm back in April. So there's a reason thousands of investors worldwide are tuned in and ascribe to the process, and the reason is because it works. And I believe it's going to increasingly work over time as I gain more experience from sitting in this seat and I continue to receive very valuable feedback from the community. Moving along in the presentation, this slide here shows our share of confirming markets. So the sum of confirming markets, right now, inflate or when I put this presentation together, inflation and reflation were tied at 16. I'll give you a spoiler alert. It's no longer tied. You can probably guess which one it is now. But the reality is, what we're trying to do is help you further understand what that actually means in market pricing terms and understand how to actually position for that. And so we do that, the share of the confirming markets. And what that really simply saying is, hey, what's this 16 divided by this total sum? So whatever the total sum is, this 16 is telling you right now it's 29% of the total sum. And that 29%, these percentages are very relevant because, as you can see, the whenever something's at the top of the page, we determine it, we connote it as the dominant market regime. Whenever something becomes the modal outcome from the perspective of this process, and this process is really helpful in helping investors visualize not only, hey, what's the dominant regime? It's inflation here. It's kind of inflation there, but it's deflation here. But more importantly, what's the spread between that relative to the other regimes? Because that spread can be very indicative of a lot of complacency or a lot of fear relative to investor positioning. And so one thing that you can see call out, and this goes back to our bottom up macro regime process, going back to the grids. As you can see, this reflation was so powerful and so obvious. And part of the reason of it being so powerful and so obvious was because the conditional probabilities in the economy were so powerful and so obvious. Well, as you can see here, this reflation is very much not powerful and obvious, and it was very short-lived with respect to, kind of we made the call back in September, said, hey, I think we're going to get another reflation trade, and that's exactly what we got. But I also, in making that call, I said, I don't think it's going to be like this one because we don't have the economic environment to support a very powerful and obvious trending aggressive reflation trade. What we've been getting really since the summertime is something we've been calling grid zero, which effectively means that those scatter plots, going back to slide 3 here, each of those dots are starting to cluster near the origin, which is very different than the world we just exited. The world we just exited is one of very massive impulses in both directions on growth and inflation, going all the way back to the winter and spring of last year. This world we're currently in now, it exists. We have to risk manage it. It's just different. This jumbled mess, this sort of lack of dispersion amongst the four grid regimes in terms of what the markets are pricing in, has been something we've been dealing with as investors all summer. So the reality is, if you don't understand that the world is very different on this side of that line as a function of the conditional probabilities, then you're obviously not going to have the same good same results as we are certainly more than likely to have subpar results as a function of not understanding that. So that's a very important slide as well.
Well, seeing that particular graph has really shown why things are so different. For
Yeah.
the past year and a half, these there have been month-long cycles where getting the right grid really told you what to do. You could pick anything in there, and you were going to continue to win on that. You may even falsely get the impression, "Wow, I'm a pretty good trader here," and then when grid zero hit, that's just a mess on that side of the curve, and it's no surprise that things are changing on a weekly or even daily basis in some cases. And until we see some clarity on what the market is doing with that, it's going to be hard to just hold on to something around it. You correctly called it a mini reflation trade, knowing that we were in there for a little while, but there's no way we're going to stay there. On that other grid graph where the boxes for the different months they were very near the origin, in terms of a projection for what was going to happen in October, November. They were right at the origin, and now we're seeing them over on the right, which shows, of course, that inflation has picked up. They're
Mm-hmm.
heading back to the left, and so
Yeah.
the question is, how fast are they going to move over there, and at what time are they going to start moving over there, is going to be critical. And then, as you also pointed out, separate from that is what does the market think it's going to
Mm-hmm.
happen there, because they're going to front run this. There's no doubt on that, and the
Totally.
question is how much. And if that inflation and deflation bars just continue to rocket up and take a dominant uh, uh, share, then we're going to see a very different market over the next month or two.
Yep, absolutely. You hit the nail on the head. And the whole point of the bottom up process is to identify particular moments in time where that actually might start to occur. And so going back to that process, you could see, you see this just looking at the table, you could start to say, hey, January is probably right around when you might expect the markets to really start to transition to deflation. Or certainly if you look at it just purely from a US economic standpoint, the probability you really start, yeah, it's January as well. The probability really starts to rise there in that particular month. So again, what we're ultimately trying to do is not front run the process, but allow our bottom up macro regime projections to, at the bare minimum, not put us in exposures on the long or short side that will cause us to lose money in the pending transition. We can know if we know the D's are coming, the last thing I want to do is be long something that's going to underperform in a D. The best thing I can do is be long something that currently outperforms in inflation and could still maintain its outperformance according to the deflation back test as well. So that's what we're trying to do here. But again, I think this slide I've gotten a lot of great feedback on this slide saying, hey, this slide explains a lot in terms of what markets are doing. Like it's a very obvious deflation here. You get very obvious Goldilocks in the spring of last year. Made an extremely powerful call. I think made an extremely powerful call for the deflation. For those who are paying, who could afford to pay, made a very extremely obvious call for Goldilocks there. But more importantly, I think probably the biggest, one of the most positive calls we made, in my career certainly, was saying, hey, look, we're going to see the most epic reflation trade, quite frankly, of all of our careers. There's about to be 5 things that happen. And we're making this call in early November of last year, of 2020. And I said, hey,
Now,
5 things are going to happen. Oh, good. The
when
growth.
you when you
Go
say
ahead.
call for that's interesting. There's kind of two different aspects to that. One
Mhm.
is when you see the numbers start to converge. There's a call of kind of a yellow flag. There
Yeah.
may be a phase transition coming. You don't know if that's going to happen or not. And we've seen several kind of head fakes with deflation recently. There's another aspect of call where it's now briefly after, when those transitions have occurred, and you can say, not from a conviction standpoint, from a data standpoint, the transition has occurred, and you really want to be getting into that new regime fairly heavily.
Absolutely. And again, that's all a function, or all a reflexive process. When you see that transition occur, you can look at the bottom up macro regime process, again, independent process, and say, hey, how much time do I have? How much time do markets have to price this in? When we made the call to go towards reflation in early November of 2020, we were saying, hey, look, over the next 3 or 4 quarters, we're going to have, basically 5 things that happen, or sorry, over the next 3 quarters, 5 things that happen that almost never happen at the same time: growth accelerating, inflation accelerating, corporate profit growth accelerating, record is fiscal easing, record monetary easing. It's been 10 quarters since 1960 where those things have happened, and 3 of them occurred in this particular period. That's why you got such an epic reflation trade. And so we understood that based again on the independent bottom-up macro regime process to put that trade on. At the same time, we've known to put on the grid zero portfolio since the last few months, because we understand that the dispersion in the market regime and the market's pricing in of these four distinct economic regimes was likely to be limited, again, as a function of the flat distribution of probable outcomes from the perspective of those conditional probabilities. So skipping ahead, speeding up. I don't want to take up too much of your guys' time here. We appreciate you guys tuning in. So dominant market regime, that's what you're seeing on this chart. It's just whatever line is at the top of this chart, or whatever line is the modal outcome from the perspective of the share of the confirming markets. That is said to be the dominant regime. We generally try to invest according whatever the dominant regime is. Sensibly assuming we have color and conviction on the sustainability of the dominant regime. Every systematic, every quantitative process is going to have head fakes. There's head fakes in time. And so ultimately it's our job as investors to use the bottom-up macro regime process to identify those head fakes in real time and say, hey, I think this is going to be a head fake. Other times they're saying, hey, no, the actual process is telling me this is going to be deflation. So when it transitions to deflation, you need to be betting on deflation. And that's obviously what happened in Q4 of 18. A lot of you guys know me for making that call. And it's certainly last winter as well, making that call as well. So one of the things that's part of the process as well. So one of the things we're looking at is also to help us going back to the conversation that Larry made about getting out of exposures. We use our cross asset correction risk indicator as a proxy for whether or not it's investors have taken on too much risk. The CTAs, the quant funds, the macro funds, which continue to blow up. Like it's macro funds at their worst month ever in October of this year. I can't understand for the life of me why they won't just pay $50 to $100 a month to subscribe to something like this. But it's, if you're running $50 billion, you'd think that'd be a thing you'd pay for. But that's neither here nor there. What is here is CACRI, and CACRI, again, stands for Cross Asset Correction Risk Indicator, and that's just the combined shares of inflation and deflation. And so what you do with this analysis is designed to signal is, hey, when those combined shares are really high, clearly the market is priced in a tremendous amount of negativity. In so much that when the combined shares are really low, the market is pricing in a tremendous amount of complacency. And as you can see, there's times where prices in complacency, that doesn't mean the market has to crash. This is part of the most epic reflation trade of all time, as we call for, going again back to November 2020. This should have happened. The problem is when it happens when it's not supposed to happen. That's when you get market crashes. That's when you have big market events associated with that. When you see that complacency build up into an economic environment that suggests investors should not be complacent. And so, historically, just to give you some statistics on this, ahead of there's been 12 8+% corrections in the S&P 500 since the beginning of 2010. 12. The median CACRI reading ahead of each of those 12 corrections was 15%. So when CACRI breaks below 20 in an economic environment where market participants have no business being complacent, we have a big correction ahead of us. And so this is something we use as part of the process to help investors say, hey, the market's been grinding higher in an inflation or deflation regime, but now the CACRI is suggesting that, hey, investors have taken on too much risk. The CTAs, the quant funds, the macro funds have taken on too much risk. It's time for us on Team 42 to take less risk, because we don't want to be getting out of the trades after them. We want to get out before them. Same thing on the upside. CACRI tends to peak or in the high 80s, low 90s whenever you've been on the other side of a market crash, whenever you've been on the other side of a big drawdown in stocks or a big drawdown in risk assets. So, if you get a big drawdown in risk assets, let's say in the first half of next year, we'll see CACRI get to here and say, hey, no, we got to start buying. We don't need to wait till, someone's signal says the VIX is bearish or whatever. We don't need to wait. We don't have to wait. We'll see that in real time, just as we saw it in real time going back to into late March of last year. You don't even have to wait for the full regime process to pivot to actually start to dip your toe back in on the water on the long side again. What we're really trying to do is, again, identify asymmetric opportunities that are given to us by the market as a function of asymmetric dynamics occurring in the economy that, again, are all eminently forecastable if you have the math and the tools and the models to do so. And so on slide 27 here, we're summarizing this all. So this is just the market regime summary table right now. Inflation and reflation were tied. Again, this is on November 24th. Subscribe for the updates. And then on the bottom up macro regime summary table, this is again, what's been realized in the economy, what we expect to happen in the economy, and then just summarizing that over the next 3 to 6 months. And so, our investment decision making process kind of lives in this 3 to 6 month forward window. And as you can see on a 3 to 6 month forward basis, over the next 3 months, inflation is the modal outcome. That's that 43% there. On a 6 month forward basis, deflation is the modal outcome. That's that 50% there. And so, as an investor sitting here today, over the next 3 to 6 months, this is the most likely economic scenario, sitting in inflation, transition into deflation. Therefore, the decisions you make in your portfolio, particularly around the exposures that you came in, the legacy reflation exposures you came into Q4 with, you need to understand that some of those reflation exposures may not work in a transition to this over the next 3 to 6 months. So that's when you want to be actively booking gains and looking to rotate, again, using those scatter plots, using those grid asset market backtest scatter plots to get you into the right exposures there. Kind of wrapping up here. So going back, we skipped a few slides. One thing that's core to our process, again, each of these columns in the table are being instructed by our volatility adjusted momentum signal process. And what that process is designed to do is score asset markets on a medium term price momentum basis, but actually confirm whether or not the volatility markets supporting those asset markets are actually confirming that. And so what you're trying to see is if, okay, is price momentum positive on a medium term basis, but is volatility on the side of the distribution that says, price momentum should be positive, or is volatility inside of its distribution that says price momentum should be negative? And so whenever you have a disconfirmation, you get neutral, you get neutrality, you get gray bars. That's when you have positive price momentum or negative price momentum and inverse volatility relationships. Obviously, whenever you have negative price momentum and volatility is on the side of distribution that says you should be having negative price momentum, that's when you get the red bars as well. So that's how that process works. And then we have our probable rescale range process that is quantitatively linked to the actual outcome here in our volatility adjusted momentum signal process, such that you get asymmetric skew to the downside whenever, we get asymmetric skew to the upside whenever market's bullish, and then you get asymmetric skew to the downside whenever the market is bearish. So that helps. What that's designed to do is help investors understand that, hey, when you're in this part of the process, going from neutral or bullish to neutral to bearish, these things need to start widening out faster than they otherwise would be in a traditional rescale range process. And the reason for that is because markets crash from oversold lows, in so much that when markets are at this point in the process, they gap higher from oversold lows and they hug the upper boundary of the probable range so much. So when something's transitioning from bearish to neutral, what you're going to see is that skew change in respect to the probable distribution. You're going to go from something that looks like this to something that looks more even, and then you go bullish, you're going to have something that looks like that. So again, it's obviously being dictated by the very local price and volatility dynamics of the market, but it's also being dictated by the medium term volatility adjusted momentum signal as well. Because again, we think that those types of signals really help you reorient your risk management. And what I mean by reorienting your risk management is, am I buying on dips or am I selling on rips? That's that fundamental question is being answered quantitatively for you in our volatility adjusted momentum signal and probable range process. And so we do that every week for investors, looking at obviously every exposure, ETF exposure in our portfolio construction up to 25 at any given time. But we're also looking at that through these other core macro markets as well, dollar, break evens, 10-year yield, high yield OAS, Bitcoin, Ethereum, gold, silver, all these things that investors have a lot of interest in and participation in. We want to provide not only those signals, those probable range signals, but also the descriptive statistics. Because again, if you have a quantitative process, there should be descriptive statistics associated with the quantitative process. And more importantly, if you have a quantitative process, you should have head fakes that you need to understand how to risk manage in real time. If you have neither descriptive statistics and no head fakes, you don't have a quantitative process. I can assure you of that. Larry, you've built a lot of quantitative processes in your lifetime. Am I missing the mark?
No, you are spot on. Two quick questions on those, if I could.
Yeah.
One is, you said a kind of a medium term range. Is that a couple weeks, a couple months, and is it quick enough to be able to catch a transition in time?
Yeah, absolutely. So the volatility always breaks out or breaks down before the price momentum. That's something Benoit Mandelbrot proven, and that's something that learning is something I've used to build these models. And so the reality is you're going to see the transition to neutral first whenever you have a big inflection point in asset markets. And so yes, for the duration on the medium term trending signal for most of these markets is somewhere around 100 days for most risk assets. But for something like currencies that are a lot lower volatility, we're looking at something like 150 days.
Oh, okay.
Yeah.
And then with respect to the ranges within your process, do you tend to kind of trade or trim at the top, going down to the bottom? Is that something up to an individual investor, or is it like you're not really playing the mean reversion game? If my model says something is going to go good, I'm going to stick with it. How do you kind of approach that within your process?
Yeah, no, I think that's for every investor just to skim that cat. And so, as you know, you obviously subscribe to the Around the Horn. One thing I talk about every week in the Around the Horn is saying, hey, this is overbought here, or this is oversold here. And so there's different types of option strategies investors can use to take advantage of those immediate term signals. There's obviously you can add to positions, you can trim from positions. What we're doing is flagging the signal. I'm not going to take it a step further and say, hey, well, we're going to take it from a 4% position to a 3.5% position. Nobody needs me to do that. You guys can all react to something being overbought and something being oversold yourselves. And so that the reality is, I don't know what everyone's doing and how the turnover investors are seeking in their respective portfolios. More importantly, there's no way I can create a process that is appropriate for all investors on Team 42 with respect to that. So the best thing I can do, sitting in my side of the chair, sitting on my side of the table, is just flag the signal. Hey, this is overbought, this is oversold. If you are a shorter term risk manager, if you're someone with a higher turnover in their portfolio, here's an opportunity to take to book some gains and reduce the position size. Here's an opportunity if you've taken gains and reduced the position size, there's an opportunity to gross back up. And that's exactly what the process does, exactly what we talk about every week in the Around the Horn, again, going across each of those positions in the portfolio construction.
That makes sense. One of the additional pieces of data that you put in that chart that if you don't look for, you won't necessarily catch is the historical average 5-day look ahead forecast for it. That's one of the things that I look at in determining whether I should be taking action at the bottom or top of the range, because it matters to me if it's at the bottom and the mean 5-day response to that looking forward is positive, then I'm looking to to jump in a little bit more to that, add some calls maybe, and if it's negative, I'm going to be more cautious about buying it at the bottom.
And what Larry's talking about is our descriptive statistics on the probable ranges. So here, the mean 5-day forward percentage change when that was this S&P 500 here we're looking at when it violates its lower boundary of its probable range on average, the 5-day forward percentage change is 70 basis points to the upside. When it violates the upper boundary of its probable range, it's 70 basis points to the downside. And so obviously that's telling you that, hey, these ranges are working in terms of actually, catalyzing immediate term reversals in price momentum. So
And
that's
that's
something
over
to take.
all time, all regimes. That's not
Yeah.
broken out by anything, right?
Yeah, this is endemic to or the back test itself is endemic to whatever duration is featured in the chart, in the upper chart. Yep. So trailing 4 years right there. All right. So skipping ahead, trying to wrap up. I know you guys appreciate everyone's time. Kind of lastly, so we've covered all the major topics. One thing I did want to highlight is sort of some of the ancillary tools in the toolkit, starting with our 4 horsemen of market risk. That's the VVIX ratio here. That's the high beta, low beta ratio here, the small cap, mega cap ratio here, and the value to growth ratio here. What the reason we look at these ratios is sort of twofold. One, they're very instructive in sort of helping investors understand, or at least helping me understand, when the market is trying to transition to a different grid regime. Obviously something like the high beta, low beta ratio is going to be bullish in a Goldilocks or reflation environment and tends to be bearish in a deflation or inflation environment. The secondary consideration we're looking at for these particular ratios is whether or not they're all bearish or all bullish. And all bullish signals clearly telling you that the market is increasingly risk on, and therefore you need to react to that accordingly with being incrementally risk on with respect to your portfolio. The more important signal, and I think this is a very important signal given everything that's happening today, Friday, November 26th in asset markets, is when these things all go bearish together. Because when they all go bearish together, you sirs and gentlemen and ladies, are in a market crash when they're all 4 bearish together. And so, and more importantly, they all tend to go bearish together ahead of the big moves. We've sequenced this going all the way back to as far as we can get these data sets. And every single time you get a 4x bear signal with these 4 horsemen, it's typically very early on into the process of one of these. Here's all 4 bearish. And when you get that all clear signal or all get the F out signal, you need to react to that in real time accordingly. And so this is something we update every day to understand, hey, we've been in some very buoyant markets. Valuations are really high, margin debt's really high, all these stuff that the bears are pointing to. But right now, one of the things that's helped us remain invested throughout this sort of very choppy period is the fact that we have not seen all four of them go bearish yet. But again, they could be very much in the process of doing so over the next week or so, just given this new Delta strain. So when we see that, if we see that, we'll make the pivots and make the appropriate adjustments. But what we won't do is overreact to news and narratives and things like that, because that's not helpful as well. That's certainly not helpful. And
Well,
then
not gonna lie,
lastly,
on days like this when emotions are high and worried and all your friends are panicking, the market's having some very quantitative and back tested signals to go by is important. Those being in good shape and risk on has very much helped me to stay in and to buy the dip. And
mhm.
look, I have to get more into the morning note. I haven't looked at that in detail today. Knowing what to do next is going to be very helpful as well.
Absolutely, absolutely. So lastly, sticking with the theme of ancillary tools in the toolkit, one of the things we look at is crowding through the lens of volatility or risk premia, as we calculate it, looking at the 30-day at the money put implied vol as a percentage spread relative to the mean of 10-day, 20-day, 30-day realized vol. The reason I look at it that way is to overweight the back test sample, overweight that sample to anything that is recently corrected or has not recently corrected, so that I know whenever I'm up here, something's probably has not corrected yet, and I know when I'm down here, something probably has corrected yet, because given the overweight of the 10-day realized volatility in the sample. The reality is looking at 90 110 moneyness skew on the x-axis on a 1-year z-score basis. And so for those of you who don't know that, that's what the cost of puts on a 10% downside puts cost relative to 10% out of the money calls. Looking at that skew on a 1-year z-score basis. So the reality is, what we're trying to do is identify exposures that are at one of these four extremes. You're climbing the wall of worry. That's when you have a high implied volatility premium and a low level of skew. That means markets are medium term bullish, but they're very concerned about the very near term risk. This is another extreme. This is the most bullish extreme, is when markets are medium term bearish, as identified by the put skew being very high on a 1-year z-score basis. But also you got a high implied volatility premium as well. So investors are very nervous about the near term and the medium term as well. You typically want to fade that as an investor, in so much that when investors are worried about investors are very sanguine about the medium term outlook, as evidenced by the put skew being really low on a 1-year z-score basis. And more importantly, you're just looking at something like China. Look at the implied volatility discount is emerged, and investors are very not concerned about near term market risk. So they're both sanguine with respect to near term, but they're also sanguine with respect to the medium term as well. You tend to want to sell those or short those types of instruments. That's exactly where the SPY got on February 13th of 2020. SPY dripped down in here and said that was it. And as we all know, the next month was pretty negative in terms of returns. So that's clearly not what we have here. The SPY obviously has a very high implied volatility premium, and that's one of the reasons today, again, November 26, 2021, the SPY is demonstrably outperforming all of the risk assets, because everyone has the same hedge on. And the market can't go down when everyone has that hedge on. And so that's something, again, we want to use the volatility options markets as an opportunity to fade, but we don't want to fade this. This is noise. We want to fade big extremes, big deviations. The closer you get to any one of these boxes, the more likely it is that the signal is lucrative.
Now, in terms of taking action on the chart, are you mostly looking at the upper right, lower left, or any of the four corners?
In terms of taking action, upper right, lower left. In terms of explaining market performance, these two become very important as well. For example, the TLT got in here a few weeks ago, and it was very clearly telling you, hey, the market is done shorting bonds. The global macro hedge funds allegedly didn't get the memo that we tried to give them for $50, but the market is done shorting bonds. And so much that all throughout the summer, you had most of U.S. equities kind of gravitating in here, and it was telling you that, hey, even though we're going to get these OPEX driven corrections, we're not necessarily going to see the market crash, because again, there's a lot of fall premium baked into the cake that's likely to prevent a bigger drawdown. And again, our CACRE indicator, cross asset correction risk indicator, was suggesting that as well. In so much that the bottom-up macro regime analysis was supporting that as well, in terms of not seeing a material deceleration in growth. And that's something we expect to occur in late Q1, early Q2 of next year, according to the models. Dispersion analysis is very important as well. And so going back to understanding how asset markets have historically behaved in each of these grid regimes, back to slide 15, the reason our dispersion analysis is super important is because it tells you in real time where the hot money flows are going. So you look at it, understanding that, hey, when you're Goldilocks of reflation or inflation and deflation, what tends to happen is that you typically get some very consistent and sticky style factor and sector leadership and laggardship whenever you're in these regimes. And so taking it back to our dispersion analysis, one thing we're looking at with what we're looking at is the month-on-month Sharpe ratios across 50 different U.S. equity sectors and style factors. 50 different U.S. equity sector style factors. And again, we have these sort of mega cap type fame names in there as well as a secondary consideration. But the reality is what we're trying to do is identify the composition of the upper quintile, whether or not it's pro-cyclical or defensive, relative to the composition of the lower quintile. Is it pro-cyclical? Is it defensive? And one very important, very lucrative way we use this process going back to September, we noticed in mid-September, after 3 months of the market trading very defensively, i.e. you saw defensive sectors and style factors firmly represented in the upper quintile, 70, 80, 90% of the exposures on a consistent basis from June all the way through mid-September. And you saw a consistent representation of cyclical sectors and style factors, value, high beta, high debt, high leverage, the SPACs, IPOs. Those things were consistently dominating the lower quintile. Again, we're talking 50 sectors, style factors here. That flipped on its head in September. We said, hey, look, the market is correcting, but the market is actually getting more pro-cyclical. It's actually getting more offensive. And this is very similar to what we saw in October of 2020. Going back to the September correction in 2020. So we had basically back-to-back 9-10% corrections in September and October of 2020. The first one, you saw defensive lead to the upside and cyclical sectors lag to the downside. The one in October, the second correction last year, you saw cyclical sectors lead, and it was obviously a leading indicator for the market to transition to reflation broadly. And so this dispersion analysis it's the hottest money flows because, again, what we're tracking is month-over-month Sharpe ratios, which is the most important metric to track if you're trying to get a real-time read on hot money flows, like the pot shops, the Citadels, the Millenniums, the Balyasny's, the 0.72s of the world. These guys control a tremendous degree of market turnover on a daily basis. It can be anywhere from 50 to 90%. I've seen, statistics out of JP Morgan's prime brokerage, Goldman Sachs prime brokerage over the years in terms of the dominance of those types of market players on any given day's market turnover, on any given month's market turnover. And so it's very important to understand how they're behaving, how they're positioning, if their fundamental views are changing, and more importantly, what their risk management systems are telling them to get the heck out of or cram into. And so that's why we track this, because again, oftentimes it's a leading indicator for the transition in the broader market regime that we're all trying to use and orient our risk management process towards.
The dispersion chart then is mostly for understanding and changes in what's occurring in the top or bottom are the things to most look for. You're not looking, well, I mean, an investor could choose to ape in like the big boys are doing, but the fact is they're not doing so great this year. But it's more the transitions that for understanding than in a specific action for what you're doing. Is that a good take on it?
Yeah, Larry, it's the latter. You're absolutely right. And so part of the reason we look at this and look at everything in this chart, everything in the slide deck is something I look at every single day, every single morning in order to write the lead off morning note. I update every single one of these models and see if something changes. And the reason I look at these things on a consistent basis, going back to this dispersion analysis, is because I can see when the composition starts to change. And that composition starts to change. I'm not concerned about any one bar, any one exposure. I care about, is this thing broadly defensive or is it broadly cyclical? And if it goes from being broadly, it's defensive now, but it's unlikely to go to broadly cyclical anytime soon. But if it changes, then that's something that's a leading indicator for the broader market regime process. So I'm looking at it as a leading indicator tool. It's sort of the leading edge, in so much that the four horsemen are a leading edge of our downside deviation risk, trying to prevent downside capture. This is our leading edge of potentially trying to help us maximize upside capture in terms of helping the front runners front run the actual change in the market regime. And then lastly, on slide 40 here, looking at CFTC futures and options data. I'm sure everyone is familiar with that. We look at it on a 3-year Z-score basis in terms of how to read this table. So you got the non-commercial net length, the 3-year Z-score. We look at it on a week-over-week delta as well, month-over-month delta as well, 3-month delta as well. And what you see here in these blues is when the back test is triggered. And so, for example, this week-over-week delta in the British pound minus 21,000 contracts that week over week delta is a -2 sigma delta on the trailing 1-year look back. And so historically, whenever you've seen a -2 sigma delta for the British pound, you've seen on average minus 0.7% 3-week forward performance. So historically, that's been a negative signal with respect to the back test, and these are trailing 10-year back tests looking at each of these individual columns and data points. So again, I think it's probably it's the laggingest part of our process, but a lot of times it does confirm ahead of time, or not ahead of time, in real time, some of these big market movements going back to the summertime when, we pivoted to being long bonds back in early May. And, this thing was like raging short of bonds, raging short of the 10-year, raging short of the long bond. And obviously those things have materially moved in the opposite direction as interest rates faded from their early 2021 peaks. And then lastly, kind of wrapping up here, everything as I mentioned, everything in this presentation is something that I update and refresh every morning. Everything in this presentation is something that I update and refresh every week, heading in to prepare myself for the Around the Horn. Most of the analysis is presented in the Around the Horn presentation. Most of this analysis is presented in the leadoff morning note, and certainly we expand upon all of the analysis with actual qualitative analysis, things like, where is inflation headed long term, where's the fiscal deficit, all that kind of information is presented in our monthly macro scouting reports. Those range anywhere from 125 to 150 slides of just charts and data. So for those of you who are probably along the institutional side of things, or discretionary managers of investment of RA type firms or wealth management type firms, that is super important, especially to help you guys and gals prepare for client meetings and things of that nature. So just kind of wrapping up, taking it back to the slide here on the portfolio construction. One thing we're trying to do is two things. We're helping investors understand how much risk they need to be taking according to the grid regimes. So again, this is a function of the 3 to 6 month forward outlook from a conditional probability perspective. Right now, the 3-month outlook for this is, hey, we got to have a decent amount of this. We're continuously rotating, shrinking the size of this pie, and either giving it to cash or giving it to deflation based on how close we are to realizing those Ds in time. And then secondarily, based on those scatter plots, the grid asset market backtest scatter plots that we discussed, we actually go in and say, hey, I want to go find I want to find a way to be long 40% inflation. So let me go find equity and commodity exposures and fixed income exposures that actually agree with that signal. And so each of these are ETF exposures that we help you, again, risk manage every week in our Around the Horn by updating the volatility adjusted momentum signals and probable range processes for each one of them. So with that, wrapping it up, Larry, I appreciate you, man. Thank you so much for joining us. Thank you guys, everyone, for watching. We appreciate you tuning in, checking out our process. It's always evolving. It's always growing. But the one thing it always will be is it'll be honest. It'll be integrity. There'll be integrity. There'll be truthfulness. And they'll always be backed by math and data, not marketing. Thank you.
Very much appreciate that, Darius. Thanks for being on. And for those who like to discuss these things in a forum, the learning the process group on Facebook is we appreciate Darius explaining this in some more detail, and we discuss this in a very neutral, calm, data-driven, respectful way. So that can be a little bit rare within the social media, but we try to keep it to that, and we consider Darius and many other services. We're trying to help the individual investor as critical for us developing our own processes. So thank you so much for allowing me to be a part of that today, Darius. Appreciate it.
I appreciate you, Larry. Thank you so much, guys. I appreciate it. Everyone have a wonderful weekend.